For the stock market, it's down. For bond prices, it's down. For the Fed to raise rates, it's still up. That's the bottom line. We're in August, and we've had this massive bounce in all risk assets. So I look at this as this is the beginning of something that's really bad. And then I ask myself, why is it bad? Well, the bottom line, number one lesson in markets is liquidity. The M2 is running. Money supply is still negative, most ever, 3%. The Fed is still tightening rates. China is playing out like an Ayn Rand Atlas Shrugged. It's one person trying to manage an economy that's way overdue for a collapse. Most of the trading in the world really for cryptos comes from Asia. And I look at this as Bitcoin's the best leading indicator.
Bitcoin and other major cryptocurrencies, including Ethereum and XRP, experienced a sudden price crash this week, triggered by a stark crypto warning. Bitcoin had surged into 2023 but encountered resistance as traders grew concerned about the possibility of the Federal Reserve orchestrating a significant pullback. This unease intensified after the U.S. Securities and Exchange Commission postponed its decision on a highly anticipated spot Bitcoin exchange-traded fund application from Cathie Wood's ARK Invest. The Bitcoin and crypto market is now awaiting a series of SEC decisions on spot Bitcoin ETFs, with BlackRock, the world's largest asset manager, taking the lead. During this period of uncertainty, the overall cryptocurrency market cap has declined by approximately 6.6%, surpassing losses in the Nasdaq and S&P 500. CoinMarketCap reports that around $60 billion has been wiped from the total cryptocurrency market capitalization. This sudden downturn comes after an unusual period of stability, during which Bitcoin traded at nearly $30,000 for over a month following a surge driven by multiple spot Bitcoin ETF applications, notably from BlackRock in June. Mike McGlone provides insights into the Bitcoin crash, suggesting that a return to earlier price levels wouldn't be surprising, especially if the macroeconomic conditions persist as they are presently. He elaborates on his reasons for this in the video below.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Markets go to the point where they can create the most pain. That's bottom line. Getting into how you fix the transmission on the car is something I learned to deliberately ignore in the trading pits in the 80s. And that's why I wish the best for traders. Most of them lose money. A lesson I learned from Jim Rogers. A lot of you know who he is. If you don't, Google him. I met him probably 15 years ago, at least 10 years ago, in Singapore at his home. Was the best positions he's ever had are the ones he got involved in, never looked at, just I don't want to see the statement, don't look at the trade. That's the way I see Bitcoin. You're not supposed to trade this, although it's the best trading vehicle in the world. Let those absolute complete professionals trade it. And that's the thing I learned in the trading pits. Those guys who traded analog back then were a bunch of slobs, but they got in the pit, they'd rip your head, they're a bunch of sharks. Now it's just so automated and bots and everything. I just say, thank you. No, I say, don't mess with it, but you hit stops. The path of least resistance right now for Bitcoin is down. For the stock market, it's down. For bond prices, it's down. For the Fed to raise rates, it's still up. That's the bottom line. We're in August, and we've had this massive bounce in all risk assets. So I look at this as this is the beginning of something that's really bad. And then I ask myself, why is it bad? Well, the bottom line, number one lesson in markets is liquidity. The M2 is running. Money supply is still negative, most ever, 3%. The Fed is still tightening rates. China is playing out like an Ayn Rand Atlas Shrugged. It's one person trying to manage an economy that's way overdue for a collapse. Most of the trading in the world really for cryptos comes from Asia. And I look at this as Bitcoin's the best leading indicator. So I'll end with this. Let's look at just simple numbers. And the goal is not to get people upset, but I need to point out facts of where we are. Right before we had this massive pump in liquidity, M2 money supply, which went up 40% from the end of 2019 to the peak in 2022. If you look at every risk asset, stock market's basically unchanged versus that. Gold's basically unchanged versus that. Commodities are basically unchanged versus that. And Bitcoin's up about 200% versus that money supply. So I look at this as it's very likely we're just going to gravitate towards those means that we were trading at right before this big pump. In Bitcoin, that was below 10,000. I just pointed out facts. In the S&P 500, it was below 3,000. It's around 3,000. And crude oil is 57. So that to me that's the current trajectory, going back to those levels. And the bottom line is the Fed's still tight. So if you want to focus on macro, I'd say forget about trading. Let the people, those other, all these things I really deliberately click off when I click on cryptos when they talk about trading. The market's going to go up because it went up. be careful with those mantras. Those days are over. We've just had the biggest zero interest rate policy rally in our lifetimes, and it's all changed except for in one country. China's cutting rate. So I look at this as that asset that led the way. I published about this morning that Bitcoin to me looks like the stock market did in 1930. It is heading lower on a 100-week moving average. The Fed's still hiking rates. The big difference with the stock market in 1930 is the Fed was cutting rates and trying to help save things.
Yeah.
I have to point out the biggest important difference where Mike and I disagree is on all of his analysis on stocks. I tend to agree. There's this thing that we don't like to talk about as traders, but we call them fundamentals. And and fundamentals are exactly the opposite for Bitcoin versus the stock market. That's just fact. If you look at the hash rate of Bitcoin, if you look at the network, you look at the use cases, whether it's from Argentina to Venezuela to Turkey, etc., the amount of people who have currencies that are depreciating and paying globally are higher. If you look at the holders who are in Bitcoin, yeah, there's a core. I don't know what percentage of the 75% that haven't been willing to sell any of it.
The drop in Bitcoin's value presents some less obvious underlying factors. The broader macroeconomic outlook has appeared uncertain in recent times, particularly due to concerns about China's state-owned property developers facing financial difficulties. Contrary to initial reports, the market downturn is not solely the result of massive Bitcoin sales by Elon Musk's SpaceX. According to new research, speculators who hold Bitcoin have incurred losses of nearly 90% following the sudden drop in Bitcoin's value to $26,000. Although this represents only around 10% of the total market decline, it has significantly impacted market sentiment. Bitcoin price predictions now center around $25,000 or potentially even lower. This shift marks a departure from the extended period of sideways movement the market had grown accustomed to. Mike McGlone continues to provide his outlook on Bitcoin and overall market sentiment, shedding light on his expectations for the coming days. Let's return to the video for more insights.
Here's a key thing I want to point out is 2018, I think it was 19, when the New York Fed came down on Tether and Bitcoin and Tether wobbled. It was around 5,000. That's when I got bullish on Bitcoin, around 5,000. Again, it went to 69. Didn't get the top, but that was a pretty good signal. I'm looking for any kind of signal to flip this downtrend narrative, which is clearly intact. And fundamentals are great. That's why I think in the long term, buy, hold, and invest. But in the short term, the best performing asset in history can easily go back to 10,000. It's still the best performing asset in history, particularly if and that, of course, is key thing about all correlations go to one, but you can't, this stuff has never happened in our lifetimes. We have money supply running negative. Bitcoin, it's never happened in our lifetime, life of Bitcoin. The 100-week movement average is trending lower. The high in this move was at the 100-week movement average. It's trending lower, and the Fed is still tight, and the stock market's potentially rolling over. So to me, it's the macro, and Bitcoin's just that leading indicator. And what's Bitcoin usually do? It overshoots. And it's also such a baby. I mean, it's just been around for so long. So I agree with the macro. That's why I started out. We're supposed to the buy and hold investors, but the traders, I think, are smart enough to know is you're supposed to be selling rallies. And by the way, because Fed's against you. And most all risk assets. And if we get lucky enough that we don't have a normal recession, hey, I'll end with this. We had our a mortgage analyst on this morning, Eric Eidelborg, pointing out, mortgage is heading to 8% and pointing out the affordability index in U.S. housing is the lowest since the 1980s. We've never had an affordability index this low without a severe recession. That's global. I mean, it's worse in China. So I'm going to point out the macro. And here's, I think, about how important Bitcoin's in the macro is when I fill out my taxes, I have to point out if I buy, hold, or sold any type of cryptos. I've never seen that in any other asset. Personal consumption expenditures, employment cost index are running around 4%. Fed funds target is 5.5%. It's very restrictive. A year from now, I fully expect we're going to be talking about severe deflation. If we're not, blame me. I mean, it's happening in PPI. It's happening. We've seen peaking in everything. The one key thing, the bottom line trigger is the stock market has to stay at these levels. It's just it's the measure of everything. And if you look back at history, if it starts rolling over, which I think it will, it's going to be severe deflation from taking money away from everybody. That's usually how it works. Now it's happening in China. Number 2 economy. It's happened in Japan. It's been happening since 1989. Now we just had this bounce or tilting that way. The bottom line is you look at Fed rate hike expectations. I look at it in the terminal every time I come in. It still shows for the November meeting, the 30%, they're going to raise another 25 basis points. To me, I look at this in the U.S. 2-year note, around 5% means you're guaranteed 10% in about the next 2 years, when I fully expect virtually all risk assets are going to just continue to, maybe be down 20%. To me, that's what I think the smart money is doing on a global basis. And then you also have talk about the dollar. The dollar is the most expensive to short major commodity on the planet. It's just hard to short it. And that's also another thing I got from our meeting this morning about, yes, we're going to see higher for longer in rates in Jackson Hole, but it's the issue in China is much worse for Europe than it is here. And I see nothing but the lessons I've learned about treasuries. Every time that people tell me since the 1980s that, oh, yields are going to go up because we're having more debt. Well, they do the opposite. Yields go down. That's been the case with Japan. And now it's still don't fight the Fed. I think the macro is just bad for everything at these levels. And hopefully we'll get out of this, particularly what's by its nature, recessions are deflationary. Now, maybe we'll get lucky this time, but the way the Fed's going right now. But I want to tilt over the one thing that I think is quite obvious from just an outsider observation that reminds me of what happened with Madoff, and that is Binance. When Binance came into the space, their volume jumped so far, so fast. My first thought, without any indication, was there's a lot of electronic trading going on. They're probably inspired by things I learned about in trading pits. When an exchange launches a new product that wants it to trade, they'll support locals to trade it. Now, I look at this, they might have done something on a very big scale to support the bots to just trade so we can get the volume and show how great we are. That's just logical. But the point is, when you see volume jump that much, that fast versus all the competitors, yeah, was it done organically? I'm sure there's a little bit of stimulus there, so that might come out. It's just like Madoff came out. And that stuff only comes out when the tide goes out.
U.S. Treasury yields saw a decline on Friday, prompted by investors' assessments of the economic outlook, particularly regarding inflation, and their considerations of potential shifts in Federal Reserve monetary policy. At 4:14 p.m., the yield on the 10-year Treasury note had dropped by over 5 basis points, resting at 4.253%. This drop came after the recent surge in the 10-year yield, which reached levels last seen in October 2022. In parallel, the 2-year Treasury yield also decreased by more than 2 basis points, settling at 4.94%. Investors closely analyzed the state of the economy and speculated on the Fed's potential interest rate hikes, especially following the release of minutes from the central bank's recent meeting. The minutes indicated a likelihood of further rate increases as policymakers expressed concerns about persistently high inflation, suggesting that additional monetary tightening might be necessary to alleviate inflationary pressures. The Federal Reserve has raised rates 11 times over its last 12 meetings, with the sole exception being the June 2023 meeting when rates remained unchanged. 3 policy meetings remain in the year, and recent economic data has presented a mixed picture of the impact of the Fed's rate hikes. While some signs suggest a moderation in inflation, other areas of the economy, notably the labor market, have displayed resilience. We'd also like to hear your thoughts on Mike McGlone's Bitcoin projection. Please share your opinions in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.